What is up, YouTube? Welcome back to Stocks by the Numbers. Today is Friday, and I wanted to do a quick review here of a stock that has been absolutely raging, and obviously with interest rates rising, these companies in this sector are seeing record-breaking revenue and profits. Name of the company we're looking at is Visa Incorporated, ticker symbol V here on the New York Stock Exchange. Stock $255.30 a share. I know it's a little bit more expensive than some of the smaller caps we've been looking at. However, if I told you, hypothetically, you had a 90% chance to make money with this over the long run, as opposed to maybe a 40 or 50% chance to make it with a smaller cap stock. If you really wanted to preserve that long-term capital that you had in your account, you'd invest into Visa before you'd invest into one of these smaller cap stocks. That's why I wanted to do the video here. Now, I want to go all the way back. First of all, the chart obviously is a straight beeline up to the top. Coming back here, about early 2015 was a split there of 4 for 1. But I want to back up here from day one, and I want to show you along the bottom here, there is a predominant color that stands out. And as we see, if you guessed green, you are correct. Also, more importantly, again, people probably did not expect this to happen. Well, I mean, some people did, obviously. But I'm sure a lot of people may have had a lot of these finance companies and credit card companies specifically flying underneath their radar. And I just want to show you, because we come back here, right, and we can see the tail end of 2019 was a really bad quarter for the company. We roll into period ending March 2020. You can see a beat on the top and bottom lines. Now, remember, this was, right, we were closed down. People were forced to stay at home. You weren't able to, go out and do anything, and you basically had to order everything online, fast food online, get shipments online. And now we see every single quarter from that dip in 2020. Look at this. Every single quarter, like clockwork, Visa has beaten not only on the top, but on the bottom line as well, with revenue now surpassing $8.6 billion for the quarter. Now, generally speaking, if we look at the numbers, in my opinion, based on what I may have mentioned in the past, we could definitely say that in the numbers, the stock may look overvalued. But the problem is, Wall Street essentially basically knows that this company is not only going to continue to generate more revenue, but also to continue to generate record-breaking profits, and that is why the stock most likely is now in like that NVIDIA realm, where it's just constant positive catalysts, so everyone and their brother is now upgrading the company, increasing price targets, expecting bigger and better things 1, 2, 3 years from now. So Visa will most likely stay up. Now, I drew these trend lines out. This is going back to the top here. It looks like July of 21, coming into where we are currently here. Just in the last about the last 2 weeks, you can see we came up and we touched that top line. And in my opinion, obviously, one of two things can happen, as we always say. But chances are, I have a feeling that we reject and maybe just kind of calm down. And again, even if it pulls back here to retest the moving average, I mean, you're talking, what, like a 7-8 point drop, right? I mean, that's really nothing when we're talking about a stock like Visa. But I have a feeling it's going to bounce around here. However, it's interesting because this does potentially look like a very long-term ascending wedge. Right? Looks like a long-term rising wedge because technically this top is higher than this top. So technically it could be viewed as a rising wedge, and let's just say hypothetically it is. If we come out here, you can see we're looking at May, June of next year before potentially it would drop down. Right? Now again, this is just hypothetical. This is not set in stone. But in my opinion, again, just based on the way the business itself has been growing, especially since 2020 after the lockdowns, I have a feeling that even if it does just bounce around and stay in this range, of course you can get it for a potentially cheaper price down here in the 230s if we sell off to the bottom of this trend line here. But overall, in my opinion, I actually think that we end up breaking higher as opposed to breaking lower. And again, I know that may throw people for a loop. However, the numbers just appear way too impressive to me, in my opinion. Now we have a market cap of about 513 billion. So in the numbers, that's why I'm saying, in my opinion, it does look potentially a little overvalued. The dividend yield now, again, the dividend they pay out, it's compared to the value of the stock currently, and that's what the dividend is yielding, right? So they're paying 0.81% of 255.50 per share. And obviously, the higher the share price goes, that's what I mean, the lower the dividend yield may go. So some people may see something like this and say, oh, they're paying out less than 1%, you know, it might not be a good long-term investment, blah, blah, blah. And obviously, we just looked at the chart, and you can tell it's a phenomenal long-term investment. So don't let the dividend yield fool you, the percentage I'm speaking about, because especially even since 2020, Visa has been significantly increasing its dividend very, very nicely for shareholders. The PE here is sitting at about 31 1/3. Now, also, in my opinion, a little high. However, again, we're talking about rising rates and record revenue and profits to go along with it. So I can appreciate the fact that the PE is now above 30 as opposed to, like 24, 25, something like that, something a little bit more quote-unquote realistic, down to earth, if we will. Also, look at that beta, less than 1. That means it is less than 1 times as volatile as the market. And this is why, again, I speak about a lot of these brand name stocks, because I understand, yeah, it may not be a $2 stock and it might not have the potential to explode to 10 to make you some crazy profits in the short term. However, again, if we look at the numbers here and you see that you're going to have that slow, steady, stable growth over the months, quarters, and years, and also at the same time, if markets get volatile, you are potentially less exposed to that risk, to that massive sell-off. That's what I mean. This is when we were getting the best of all worlds here, in my opinion. And of course, more importantly, as I mentioned, if we do pull back here to the 230s, that's what I mean. This is the Buffett method happening in action. We find a brand name company like Visa. They have the numbers to support it. And of course, all we have to do is wait for the dip, and then we buy the dip and position ourselves and accumulate shares for the longer term. If we look over here quarterly, I mean, just look at the growth in revenue here of 78 billion, 794, 799, up to 812, up to 8.61 billion. And of course, look at the profitability as well. Profit margin sitting, basically maintaining that 50 and now higher. So that 50+% net margin number is absolutely ridiculous. Look at how this company has grown just over the last several years here. Down here at 21, 22 billion, up to 24, 29, over 32.5 billion now for 2023. It's showing us, look at the profit margin since 2020, right? It seems like it's only a few percentage points. However, going from sub 48, again, almost up to 50, just below 50, now up to 52, that's more of a jump than people realize. They basically shown on a net margin percentage of already 48%, they have shown a 10% increase in profitability from that 48% level up to this 52% level here. So this is absolutely nothing to sneeze at. But again, the one thing that does raise a red flag for me is the fact that on 32.65 billion, we're sitting here with a market cap of 513 billion. So that's why, in my opinion, again, I would personally, if I was looking to take a position in Visa, I would wait for a sell-off, even maybe back down to like this 240, 230, 237 fib right here. Something like that, in my opinion, would be, of course, an ideal entry. However, I know there is a lot of chatter on these forums and online that a lot of people are expecting new all-time highs for the markets, and they're expecting them to continue to rage not only through December going into the end of the year, but of course going into January with the January effect of all the funds repositioning themselves and adding more volume into the market, especially to the fundamentally sound brand name stocks like Visa or something like a Walmart as an example. But coming over here, looking at the revenue, we can basically see across the board the company has been doing very, very well. The data processing segment is up year over year. Their services, obviously, significantly increasing here, almost a double. A lot of these numbers, this is, data processing here, as we see more than a double from 2017. In the service industry, you're seeing almost a double here, going from sub 8 to almost 15. And of course, internationally as well, the company has been growing very, very nicely, seeing almost a double in revenue as well from 2017. So that's why the company is really rocking and rolling. And they're rolling on all cylinders, so to speak. And this is why I'm saying this is not something that you sleep on. This is something that you put on your watch list. And in my opinion, you just wait for those dips. And that's when you begin to accumulate shares, especially for the long-term account. Visa, in my opinion, doesn't really seem like a company that you would trade very much. Unless, of course, it was more of a momentum trade. If you were potentially positioning yourself into some risky speculative calls, potentially, maybe a couple of days or a week or so before the company is about to report earnings or something like that, then I can understand the fact that, you may want to roll the dice with some Visa options. Or, of course, if you're a long-term shareholder, when they do report earnings, if you want to protect yourself as a little bit of a hedge, you can potentially step in and you can grab yourself a couple of puts just in case if the shares go down because they just so happen to miss earnings, or it's a negative report, or maybe margins went down, so Wall Street begins to beat the stock up. At least you can still make back a couple of bucks there in the short term on your puts. But looking here again, if we look at the states here, we can see 8.7 billion back in 2017. Now we're north of 14 billion here in 23. And of course, internationally as well, basically confirming what we're seeing up here from their segments is basically that the revenue internationally has doubled. And also, this is why a lot of people like Visa as well, because a lot of businesses accepted Visa, and of course, Visa was basically accepted everywhere. It's one of the more brand name companies out there, and that's why I think they have been so successful. Because I know I personally used to like American Express because they do still, in my opinion, look pretty attractive in the numbers. However, again, there are a couple of more restrictions with the American Express card, so this is why everyone moved, any long-term holders I'm talking about who owned credit card stock, most of them moved their assets to the Visas and the MasterCards of the world and just kind of left the American Express at the sidelines. So I can appreciate the fact that a stock like Visa is growing significantly better than a company like American Express. If you really dive into how their cards work, it does make more sense. But also, in recent news here, the Canadian Federation of Independent Business has welcomed news. The federal government has finalized agreements with Visa and MasterCard to lower credit card transaction fees for small businesses, right? So they're trying to step up. They're trying to make it a little bit easier for smaller businesses in Canada to obviously deal with these transaction fees from these credit card companies. And of course, by having companies like Visa and MasterCard agree to lower their transaction fees, a lot of people may immediately view that as, oh, well, they're going to make less money. However, of course, due to now, in my opinion, the sheer new influx of volume of accounts coming from these small businesses, it's probably going to even itself out, and I'm sure in the longer run, it's probably going to pay off and benefit Visa and MasterCard by lowering fees, because that will in turn, again, generate more volume, more accounts in general. But looking here again on the EPS side, look at this. We're talking beating by, several percentage points here, coming in 8 cents, 5 cents, 10 cents above analyst expectations. And again, they're basically expecting in February the EPS that they reported back here in October. So if this company continues to follow this trend, chances are, in my opinion, on EPS of 234, we could probably see about 240 potentially. But just this growth has just been astronomical here. And I want to check, and we see that revenue comes back down here to about 8.5, with the company just posting 8.6 on 8.55 billion. And of course, this is the period that's going to be ending in December. So, of course, going out for the holiday season, you have your Thanksgivings, your your Hanukkahs, your Christmases. So this is why chances are these numbers, in my opinion, are probably going to do well. And of course, remember that this is being reported the 1st of February, and chances are, again, due to the January effect, this stock may climb up into the 260s and 270s and hit new highs based off the January effect. Again, the January effect is when all of these hedge funds basically reposition their position, so to speak, and they basically move the funds into the better performing brand name stocks like your Visas, your MasterCards, United Health, right, which I made a video about that only got about 20 views or whatever, and it's fine because I understand that these are not the type of stocks that a lot of you are looking for. However, if you ask me, in what stock do you have high conviction over the next 1 to 2 years is going to go higher, then the answer would have to be these brand name companies with the already proven track records. Your United Healths, UNH, your Visas, ticker symbol V. This is what I'm saying. This is why, again, I understand it's slower and more boring than doing scalp trades or trying to time some calls or some puts on weeklies or something. I can appreciate that. However, again, your cash has to be earmarked for different objectives. So if you open a trading account and you deposit $10,000, you shouldn't be rolling that all into speculative options plays unless you can really almost immediately replace that $10,000. So if you're someone who it took you a very, very long time to save up that $10,000, now you finally open an investing account and you're looking for where to put it, if you want to take 5 or 10% of that capital and do some speculative trading with some options, that is entirely your own prerogative. But technically, on paper, in the finance field, they will tell you that you would most likely probably have at least 60-70% of those assets would be in, blue chip, slow, steady, stable growth stocks. That's a fact. So that's why when people come to me, I built up a $20,000 account, I got like 14,000 in like Tesla puts or something like that. It's like you may potentially be setting yourself up for disaster. And that's the problem. No one ever wants to talk about the negatives. Because, we have these sayings, our stocks only go up and all this nonsense. But at the end of the day, there are people out there that are losing thousands, tens of thousands, hundreds of thousands of dollars just because they did not stay disciplined and stick to some of the rules of trading. If you have $100,000 in your account, it should not all be in speculative plays. You have to split it up. Look at index funds, look at mutual funds, look at blue chip stocks. Yes, you could take a small percentage and expose yourself to some speculative smaller cap stocks or even some short or longer term derivatives. But also at the same time, the bulk of that capital should be secure in some way, shape, or form. And even if that means putting it into a situation like Visa or stocks, again, like a Walmart or, a slow grower that's generating decent revenue, like an Amazon, right? That's what I mean. You would look for these brand name companies, and that's where technically the bulk of your capital should be. So if you're overexposing yourself with a higher percentage of your capital in 1 or 2 positions, and then on top of it, those are speculative, extremely risky positions, you technically don't have the right to look for blood if and when it most likely does not work out for you. And again, I mentioned it in another video. If you're sitting there absolutely killing it, this doesn't apply to you, and you started with 3, 5, 10K, and now you're up to 50, 80, 120K by doing risky speculative options. Of course, more power to you, and I hope that you just continuously see gains and make $1 million. But coming back to reality here, the fact that you can start with such a smaller amount and grow it into such a significant amount, however, continue to take that significant amount and take on significant risk, in my opinion, that is very, very silly investing. You should be taking the bulk of those short-term profits that you're making and begin to roll it into shares of companies like this and build up your quote-unquote safer, more stable, longer-term investment account. So again, you went from 5K to 50K. Congratulations. If you continue doing what you did with that 5K, now you're doing it with the 50K. Listen, if you get smacked up and all of a sudden you have 2K left, you can't go crying to anyone. You have been forewarned, as we'll say. You have been warned. However, again, track record looking amazing for something like Visa. Let's get into the financials very quickly. We looked at the revenue before. Look at the earnings here. Nothing but green across the board. Even if we go annually, you can see 2018. Look at that. Missed by, what's that? 10 million in change in 2018. And then obviously before and after that, absolutely killing it. We switch over here on the EPS side here annually. And you can see, look, we've basically tripled our profitability inside of the last, like 6-7 years here. That is nothing to sneeze at. And of course, if we look at projections here, we thought this jump in revenue, 32.6 billion, was impressive. Look at what they're forecasting for the next several years here. Almost 36 billion, almost 40 billion, 44 billion, almost 48 billion. I mean, these are insane jumps here. And because rates are still high, and because people are dealing with hyperinflation and can barely afford groceries and can't even pay their rent and their mortgage and their electric bill and buy groceries, people cannot even afford to do those few things in their pay cycle. So what's going to happen? They're going to need to continue to borrow, continue to go into debt, and that is why companies like Visa have been actually performing very well since pandemic lockdowns. And we come over here, we look at the dividends. Look at this again, 66 cents a share. Just look at the jumps here, 82 to $1, right? Then we get locked down here, we're at $1.20. But this is one of the companies that was really reaping the rewards of the events that happened since 2020. So now you can see the jumps in dividend coming in, again, slightly to 128, but then obviously as they began to rock and roll even more, you can see dividends jump up to $1.50, and then they take a next chunk higher here, 20% increase, and jump up to $1.80. So this is why, again, longer term, of course, you want to buy the dips and keep your cost basis as low as possible. But based on what we're seeing here and past performance, it does seem like Visa is going to be a nice, steady grower for us, even after doing what it has been doing. The PE is up here again at 31 1/3. Not the lowest it's been, as we see. However, not the highest as well. Was trading 35, 36 times earnings. So we do still potentially have more room to grow. The price to sales here, a touch over 16. Again, was higher. However, it seems that before this, it has been sitting between maybe about 14 and 15. So this is why I'm saying we could potentially get a little bit of a dip after this nice little rally. And that's why if you could potentially position yourself here in the 230s or down into the 240s and just get this stock for a little bit of a discount here, I think you're going to be positioning yourself well, in my opinion. The stock here trading about 14 times book value, as we see basically approaching the high going back to March of 22 here. But if we look annually, I want to see annually real quick. Yeah, see, you can see the PE was well above 30, even into the 40s here. So that's why even here at 31 1/3, even though it does seem high, technically looking at the past years, it could, of course, continue to increase in value. And again, the price to sales here was up north of 20 and even higher than the current 16 for several years in a row. So again, that's why we could have a dip. However, overall, it does look pretty good in my opinion. Price to cash flow was up north of 30 and even 40. So here at 25.5, doesn't really necessarily raise a red flag that we're seeing overvalued here. We're seeing an overvalued stock here. But overall, again, the return on assets climbing nicely. The return on equity up here, almost 45.75%. Invested capital is up. The gross margin, again, not necessarily the highest it's been. However, it had to dip down here to sub 76 and then got above 76.5, now approaching basically 77.5. Gross margin percentage, you could say it's down slightly, which could be viewed as a very slight negative. However, it seems like it's basically in line with the median average price here. EBITDA sitting at about 69%. Again, not the highest it's been, not the lowest it's been. So we're basically in mean range here. And of course, our net margin percentage, which we looked at before, now sitting at about 53.5%. I mean, that's insane. That is just absolutely insane. So this is why I say sometimes you just got to follow the numbers here. You just got to follow the numbers. And it should be crystal clear, in my opinion, as to why the stock has been climbing over the last several years. If again, I'm not trying to beat you up, because I know we all have different knowledge and experience when it comes to investments. So, if you're newer to the market, to investments, if you're looking at what I'm showing you and you don't understand why Visa has been increasing, then in my opinion, you should just completely stop what you're doing and just increase that knowledge a little bit. Because they say knowledge is power. And I understand you can also make the argument that, well, the more you know, the more you analyze. So then you have, paralysis by analysis. I can appreciate that as well. But I'm talking in general, looking at how the company works and all of these fundamental metrics here. If you don't know what a lot of these metrics and terminologies are, and again, as we're breaking it down piece by piece, if you really still don't understand why this company is climbing, then again, I feel, in my opinion, you just need to go back and you need to start reading more and just educate yourself. Remember, this is your hard-earned money, right? So the fact that you put in 30, 50, 70 hours a week to generate this money, and then to just throw it into a situation, just kind of like hoping and praying it works out. Or if you just randomly buy some crappy stock, but you didn't know it was a crappy stock, and then, within a month or two, it's down 10, 15, 20%, and you don't understand why. This is what I always say. You need to make it your business to find the why. Nobody's going to take care of you but you. So this is up to you. As we see, the cash just growing phenomenally well here. Even looking at our free cash flow here, we can see, what is this, about a year and a half ago, going back to March of 22, the company had about $3.25 billion free cash flow. Now the company's $6.6 billion free cash flow for the quarter here, Q4. I mean, it's some of these numbers are just ridiculous. Liabilities have been slowly increasing, but of course so have assets as well. And you can see the consistent, basically, we had a small dip there quarter over quarter, but you can see overall just the basic consistent increase in equity here, which of course I told you would continue to increase the book value per share. And again, that is really like another potential red flag. However, again, the company is actually performing well. So I can appreciate the fact that something like a Visa would trade at a higher multiple than the average stock we look at here, looking at book value anyway. The cost of goods, just so insignificant looking at the rate of revenue coming in, in comparison here. You're talking about maybe 20%. Profit consistently increasing, except for that dip, consistently increasing quarter over quarter. This is what we're talking about. The company now has record revenue, which yields record profit, which again, as you see, gross profit minus the operating expenses yields operating income. And you can see, again, consistent increases in operating income. This is what I mean. This is why when a company reports earnings, right, a lot of people will, let me just look at the revenue. Did they beat on the EPS side? There are a lot of fundamentals to take into account. And again, perfect example, we go back, PayPal, PYPL. I'm sure a lot of you are familiar with PayPal. Again, in the Discord, we were talking about it. The company posted earnings. They came out. They beat on the EPS. They beat on the revenue. And the stock just crashed down and ended up hitting new 52-week lows as markets continued to sell off. And why? It's because operating margin expectations were 22%, and the company came in with, I believe it was 21.4%, and supposedly that is the reason why they beat up PayPal and had it hit new lows. Now, of course, the whole time it was going down, I said, in my opinion, it was an overreaction and you guys should be buying the dips. Now PayPal has rebounded from the lows up about 50. Now it's up to about 60. But in general, you understand what I'm saying, right? This is why the best stocks for you to own long-term growth are the stocks that don't even give Wall Street an opportunity. And as you see here, something like Disney, you're really not seeing an opportunity, right? Because again, the PE could be viewed as high. The price to book ratio could be viewed as high. The yearly revenue to market cap comparison could be viewed as high. However, all of the fundamentals here that actually matter, the revenue, are they keeping costs in check? Is profit increasing, right? Have operating expenses gotten out of control? Is the operating income consistently increasing, right? So that's what I'm saying. PayPal had that one negative, and that was the reason that Wall Street decided to beat it up. It slightly cracked the door, and Wall Street busted it open and just completely started shorting the crap out of PayPal. Visa, on the other hand, as we see, is not really giving them an inch. That's why, in my opinion, it consistently goes higher. Again, you can see the PE, look at this, well over 40. You know, now we're down here back into the 20s. So again, could be viewed as high, but also at the same time, could just keep climbing from here. We looked at the EPS and the revenue over the years, absolutely phenomenal. Increasing dividends. And of course, even looking at the debt, you can see, look, 2020 up here at 24.6 billion, dropped down 21.6, back up to almost 23. Now we're sub 21 billion. And, you know, just looking at the cash flow, it is just amazing here. Look at the free cash flow. Right? Look at the free cash flow here. In 2020, 9.7 billion, up to 14.5, up to almost 18, up to almost 20 billion. This, in my opinion, is a stock you should be looking for. This, in my opinion, is a stock you want to own. And also, we have stock charts here. Let's pull up stock charts quickly, and then I'll let you guys go. And if we see here, we can see the flattening coming out here, and you can see that basically right as the stock hit and broke that RSI benchmark of about 70 that we speak about, which technically on paper they tell you means a stock is overbought. But of course, that is not set in stone. Nothing is guaranteed. And you can see that it has basically kind of calmed down. And this is what I'm saying. It's like it flattened out, but it didn't drop. And that's why it's almost alluding to me the fact that it may just, you know, sell off a couple of dollars and then just take that next leg higher up into the 260s. So MACD on the daily has crossed to the downside, though, with a couple of these red days. So we'll see if it can stay above this mid-Bollinger Band here. That, in my opinion, would be the immediate short-term level that I personally would watch. But, again, RSI still up here at north of 65. So we could just calm down and just kind of flatten out for a couple of days and have a lot of these technicals just, you know, kind of catch up with each other, if you will. But again, looking here, I mean, look at this going back to, this is where the ball dropped right here. This is where the ball dropped. So, look at this. Since the beginning of the year, minus this big drop here in October, the company for almost an entire year has been not only with upward momentum and increasing in value, but also at the same time has been maintaining a value above the 50-day moving average for almost 12 months straight. And look at where the stock was in 2022, right? So this is just a complete script flip, if you will. And, you know, you're seeing the comeback of a company, of course, that is just in the right sector at the right time to completely just benefit off of all this volatility and this hyperinflation. They're really the ones that are reaping the rewards here. Top Bollinger Band here on the weekly, 257.58. Company hit a high 257.39 and has since rejected. So this is what I'm saying. The RSI has now climbed. We're here, we're dancing, we're constantly running above the top Bollinger Band. And that's why I'm saying even a pullback here on the weekly to the mid Bollinger Band here, about 241.5. That would be epic, in my opinion. And of course, obviously, if you can get a pullback here to the moving average, that would be even better. However, based on how markets have been climbing, really, no matter what the hell is going on every day, chances are I do not see 230 in the immediate short term. But also, again, over time, this is what I tell you about these good growth stocks. Look at this. Let's check this out. So this is what, September 20 of 21, right? So a little over 2 years ago. You can see, look at that 200-day moving average down at about $172. Now it's up to about 211.5. And obviously this dip throughout 2022 brought this 50-day moving average down for the short term, but in the long term it has since rebounded. And you can see with looking at the 50-day, you can say we're at about 212, about the high 212s. And then you can see the rise to 220, the dip down to 205, and now the 50-day moving average is sitting north of 232.25. So this is why, again, I talk about stocks with slow and steady and stable growth, right? Because let's just say hypothetically, everything starts chunking down and selling off. You may see a drop from 250 and change down to 230 and change here to retest one of these moving averages. However, in theory, if that could be quote unquote the low of the lows, if this stock does enter correction territory, then this is what I'm talking about when I say conserving and preserving your capital for the long term. Right? Because I'm sure a lot of other positions you may be overexposed and they may be more speculative than Visa. And if those stocks do go into correction territory, you could lose potentially 25, 40, 60% of value almost instantaneously. And now, again, obviously it's not worst case scenario because you need to know when you buy a stock, the company could go out of business and the stock could go to zero. You need to understand the risks involved. I don't care what company it is. But again, at the end of the day, if you're telling me supposedly some of what could potentially be worst case scenario could be about a 10% drop, this is what we mean when we say look for these stable growing blue chip companies. Because if that's the worst case scenario, now you see you are technically on paper exposed much less to risk. That's why I like reviewing these stocks, because I understand a lot of you may only have a couple of $100 or a couple of $1,000, right? So you're looking for like your cheap stocks like SoundHound and STEM, where you can get in early and over time you can make 5-10 times your money. I can appreciate that. Or some of you who may have like $500 in a new trading account and you're just really doing like short-term speculative option scalp trades because that's really all you can afford. It's you see greater returns with a smaller account, taking on more risk with options as opposed to buying 10 shares of Campbell's or something. You understand what I'm saying? So I can appreciate the fact that some of you are in situations where you have to take on that risk. But again, if you're one of these lucky people, well, it's not even luck, really. I mean, of course, luck does have something to do with it, but we'll just say if you're one of these people who have benefited from short-term trading, and you find yourself in a place where like 1,000 is now worth 10,000, or 5,000 is now worth like 25, 30,000. In my opinion, now, literally, in this type of environment where supposedly, quote unquote, everything seems great and we just keep climbing, that is what I've learned over the years could potentially become the hands down most dangerous environment that you have ever seen. So this is why, again, I know we may be buying some of these stocks up at highs, but in my opinion, if you have seen nice growth like that on short-term speculative investments, I would advise you, in my opinion, to start to take some of that capital and tuck it away in something a little bit more secure, if you will. Excuse me. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, share the video and subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky and volatile and uncertain. I want to wish all of you success. Hope everyone makes a couple of dollars. I want to thank you so much for stopping by, and I'll see you guys in the next one.